from the assumptions to thinking about the model. And remember, with Office Depot, Office Max, we're thinking about what the strategy is, because the acquirer has pretty much a negative EPS. It's positive if you pull out some extraordinary items. The target has a stronger EPS, and the question is, what's the motive? So we talked a little bit about the fact that this is a horizontal acquisition. Oh, and on top of that, the acquirer was paying effectively a discount to the target stock price, right? They were paying, what do we say, almost a 10% discount, because they were paying $2.69 times target company shares. Target company shares is $3.77. 2.69 times was about $10 and whatever cents. A 10% discount from their current price of $11.21, which means what? We're going to have negative goodwill. And so, what's the situation there? What's the impetus? How are they going to find accretion? And so, coincidentally, despite all of that, despite the paying a discount, despite the acquirer has negative EPS, the deal is enormously accretive. And the question is why, right? This is the idea and thought process behind a case study. So let's look into it further. So once we get the screen going, what we have now is, just as we laid out yesterday, $3.77 a share. And we laid out the uses and the sources. Of course, this is a stock swap, so the majority is equity. And we said, remember, we went through the analysis to determine whether the target company was taking on the debt or not. And that's another facet of the case study that I want to make sure you're taking away. How do you determine that? And there's a bit of semantics between that, right? So we determined from three different areas how the target company, we determined that the target company is not going to take on the debt. How did we determine that? What do you guys remember? There are three different areas that led us to believe, because you're never going to be sure that the target company is taking on the debt.
We saw the performance balance sheet.
Yeah, we saw the performance balance sheet. That was the biggest clue. A lot of times you don't get to see that. The other two kind of hints. The nature of it being a stock swap led you to believe that obviously the purchase price is going to be covered with debt. And not only the nature of the stock swap, but the way the press release was written, right? If there are usually clues, not always, these are indicators. There are usually clues in a press release that would let you know that stock swap would include total consideration, right? So in this press release, it was a little bit more of company A is buying company B. They had a lot of points of benefits. One was that the acquisition terms was 2.69 target company shares. You will see, and we'll see this in the Heinz case, they might say something like company A is going to buy company B for XYZ, the terms. They would say this implies a purchase price of about $1 billion, or total consideration of $1.5 billion, assuming the consideration of target company's debt. There was nothing like that on there. There's nothing about total consideration. If you read total consideration, or if they talk directly about the debt, those are clues. In this case, there was nothing about that. So we made the assumption that that meant that they weren't going to pay down debt. And then we proved it later on as we looked through the proxy. We found that they actually had a balance sheet, a combined balance sheet, that shows that they're not paying down the debt. And again, another important thing, a lot of people get confused when they see the combined balance sheet. They believe that they have to pay down the balance sheet, if they have to model out that balance sheet exactly. You'll never get it tied. So you are not going to, if you see a balanced balance sheet, my recommendation is not to try to tick and tie every single adjustment there, because then you don't have a dynamic model that's adjustable by scenarios. The point is, what you do find in those adjustable balance sheets are, first of all, you find little write-ups and write-downs that in the due diligence process, lawyers and accountants go in and they find, okay, well, this is going to be written down by this much, and this is going to be, and that's not mechanical and dependent on variables and sources and uses. That's just literally reading through hours and hours of documents. You'll never be able to project that stuff. What their pro forma balance sheet does indicate are the larger movements giving you an idea as how the transaction is structured, such as, are they paying down the target debt or not? And we saw clearly that they weren't. You know, if they're raising equity, what type of equity is it? Is it common stock or preferred stock? You can see that in the balance sheet. The bigger movements is what you kind of want to use as a guide to match against your model. So I want other reasons why case studies are a little bit different than just templates. Okay. Now let's look at the consolidated financials. So the goodwill and intangible assets, we're going to reserve this for when we get to the balance sheet adjustments. For consolidated financials, what I want to do is I want to lay out the projections. And literally, like we do in the template, you are just adding together acquire plus target revenue all the way down to net income, except for items dealing with target debt and target equity. You should have that committed to memory. The difference here is we might have different line items for acquire and target. How do you handle those? You might have other line items. How do you handle those? Let's think about that. But revenue is simple. Office Depot plus Office Max revenue. I just go for big picture totals. If company A has like 3 or 4 different revenue lines and company B has 3 or 4 different, I would just pull in the total revenue. That's all we care about. If you think the projections are going to change the projections in the individual models that you've built. So that's the way you want to think about it. So a lot of analysts also get confused by that. Do I project in the Office Depot, Office Max, and then project again in Consolidated? That might confuse the individual entities. Unless it's a type of merger where company A plus company B equals an entirely new company C, and the projections are going to be incrementally different. We're simply doing Office Depot plus Office Max. Real simple. 18 billion. This is pretty much in line. Remember they said the combined operations would have about 18 billion in revenue. Okay, I have 17.5. Maybe I'm a little conservative here, but that's fine. Actually, if you look at, and we'll go back to the proxy, these are what the numbers had in the pro forma in their proxy. Okay, we can assume the growth. The growth is going to be obviously a combination of the growth of the individual companies, modest growth. Is it unusual? 1.3%. Are we being too conservative? What do you think off the top of your head? Anybody? No. Why?
We're paying for something, $11 a share, something like $10 a share. So it's probably an expectation that performance is great. So growing at below inflation doesn't seem wildly.
Yeah, but the way we're paying is a good indicator of our belief in the value of it and the belief in the growth of it. Yep, I agree with that. Why else? Good point. Why else? These are the questions I always get you guys. I got 2 of you guys this weekend saying they had final round case studies and they wanted me to vet them. What am I going to be asked? These are the types of questions they're going to ask you, right? So my warning to you guys is after this program, you guys have all these crazy robust models, which is great, but don't lose sight of the subjective. Why else is the growth low? Competition alleviates high growth from year to year. And what else? One other, maybe more macro. Yeah. I mean, this is retail, right? Look at Walmart. Walmart, we had a struggle with Walmart's pretty low growth. Well, actually, in the book it was 6%, but now it's lower, and this is a little bit later, 1 or 2 years later. Retail market's very low growth. We'll see it with Heinz. Heinz was like 0.04% growth. So it's the nature of the market as well. I mean, this is paper and office products, right? It's not a high growth type of business, especially as Colin said, when things are going online, right? So all those things are good subjective reasons that would be explainable for why the growth is low. AJ.
I was just going to say, yeah, I mean, it also includes to look at the industry growth rate as well to see if it's in line with that.
Yeah, absolutely. So things not to lose sight of when you're doing the mechanics is just step back and think about where things are going and why. Okay. Cost of goods sold, again, adding together acquire plus target COGS. And you want to think about the operation. So these are competitors. You'd assume that their costs are going to be similar. Their margins are going to be similar. 67% for Office Depot. Office Max, okay, a little bit higher, 71%. And that's a combined percent of 68.9%. And you can go ahead and calculate the margins, which is real tight, huh? 30% margins. So low margins, but I would assume not unusual for this type of business. So I did that quickly, take a couple seconds. OpEx gets tricky because revenue, I'd recommend pulling the totals. Oh, one thing I didn't mention, I did mention to project the revenue and the individual tabs. Good. OpEx, you might find acquire OpEx line items different than target OpEx line items. And a lot of people think about, well, what should I do? How do I consolidate? And I don't think it's so wrong just to lay out every single operating expense. Lay out the acquirer's OpEx, lay out the target's OpEx, and just calculate them as a percentage of the combined revenue to get an understanding as to what portion of OpEx is significant and what portion is less significant. The reason why I'm saying that is because really for M&A analyses, you're really about EBITDA, right? So we're really only going to deal with total OpEx in this case. So if the acquirer line item is 3 line items that are different than the target, list all 6. Just list them all. Now, in this case, because these are two companies that are competitors with each other, we were lucky in that their line items actually matched. They had store, warehouse, operating, and selling expenses, and they had SG&A. But if, like, the target company had a third line item that the acquired company didn't have, just add it. Just add it in. As long as you're capturing every single expense for EBITDA, that's what matters. So that's my recommendation there. Yeah, that's right. So in this case, we were kind of lucky. We won't be so lucky in the cash flow. We're going to take acquire plus target. And we'll calculate this as a percentage of revenue. And the same for general and administrative. Acquire plus target. Percentage of revenue. While you're doing that, I'm just going to pull up quickly the annual reports that we were dealing with, the proxies that we were dealing with before, which was April 9th. Here it is. It's the S4. I'm surprised I had a tough time finding that yesterday. It's right there. So what I'm doing now is I remember we pulled up a note on cost savings. So we talked about the significance of them, and we pulled it up in the press release. I want to pull it up here, cost savings. And they quantify them. So the tricky part about cost savings is not only are they, do we have it here? Not only are they difficult to project, people are very skeptical about them actually realizing cost savings. So this is going to be a big situation with the Heinz case. It's going to be a quite interesting one that we'll look at. Here, it's a major factor. So they quantified, I want to show it for you. They quantified they will be expected to achieve 400 to 600 million in cost savings. Okay. Oh, interesting. So here's a note I haven't read before that they kind of, this is a history of all the events leading up to the transaction, that initially they thought that they'd only have 400 million in cost savings, and only, I mean, that's a lot. But then we know from the press release that they had somewhere between, or they expect to have somewhere between 400 and 600. Here it is. The estimated annual synergies of 400, 600. And I don't have the press release handy, but that was one of the first bullet points in the press release, the benefits of the deal, between 400 and 600 million in cost savings. So I'm going to, for now, take the midpoint, but I want this to be one of the major variables in terms of determining accretion dilution at the end of the analysis. So I'm going to highlight this. And the way I'm going to do this is they expect, it actually said in the press release that they expected 400 by year 3 to have achieved 400. Here it is. Here it is. The transaction will deliver 400 to 600 million in annual cost synergies by the third year following completion of the transaction. So that's projected year 3. So what I'm going to do is, by projected year 3, I'm going to take the midpoint. So in 2015, I'm going to assume 500. That's a lot. That's a significant chunk of their SG&A. It's huge. It's more than half of it. This is one of the biggest factors to their merger. Now, is that believable? Is that achievable? I don't know. I want to know if it's zero, how it impacts the transaction. This is going to be an interesting thing. And then I'm going to say, the way we typically do it is, let's assume that it's going to build to 500. So they're going to achieve a third in the first year, 2/3 in the second year. So I'm going to do 500 times a third, or 500 divided by 3 in the first year, and have it link so that we can easily shift I-17, and have it flow through to the rest of the analysis. And then the next year, it's 500 times, in parentheses, 2/3. And we're slowly scaling up to that 500. And then the next year, it's just equal to the year before. And, you know, I didn't know if the cost savings was just going to be on SG&A or SG&A and the warehouse selling expenses, because they are like operations. So I just calculated a percentage of the total OPEX, or percentage of the cost savings divided by, in parentheses, whoops, the total of the expenses. Yeah. What's up, Tosin? Sorry, I just wanted to get that thought through. You had a question? Question? Or you were commenting on that? So.
Yeah, it was a question actually.
10% of OPEX. Let me know if you're not matching. I can help you. 10% of OPEX is a lot. And so my point is, I couldn't imagine that this was going to be all SG&A. There must have been some portion of this that was synergies. That's why I look at this as a percentage of, well, this is what they're data. Do they actually achieve that? Actually, yeah, I'm curious to find out now that it's been 2 years later. They're almost there, right? Huh? Yeah. Well, it's nice that they gave us those solid assumptions to go by.
In this case, when you see such a high reduction in OPEX, would you still consider about 400?
I'm going to take the midpoint, and then I'm going to see what happens when it's 0. That's going to help me build my story.
I mean, like in reality, like when you're running the model, you see that it's so high, you probably just go with it.
Maybe, yeah. It's a tough call. I mean, the only other thing is, I mean, it's believable. These companies are so similar, and they're probably shutting down stores in proximity with one another. I mean, they are probably cutting a lot of costs. Warehouses that are in proximity, they are probably, you know, it's believable. If this was like Procter & Gamble acquiring a brand that's a conglomerate, I wouldn't see that as much. For which one? You got it? This one? It's just, I'm just taking the 166 divided by the sum of the two. And actually, I I'm going to change this 500 to negative 500. That'll bring everything negative. Just okay, I made this negative, which means, so I'm just going to change I-17 to negative to show that it's a net against the expense, which means in my percentage formula, I'm going to do negative G17 divided by, so that the percentages flip back to positive again. So sorry about that. I think that makes it a little bit more accurate. Yeah?
You just need to keep there.
Mm-hmm. I just flipped I-17 to be negative, and then that means in the formula I put a negative sign in front of G17 to make the percentage back to positive. I just want to show the cost savings as a reduction against the expenses. So that total OpEx will just be a sum of all three. If that makes a little bit more sense. So when you get to total OpEx, it's literally a sum of ABC. And we can calculate the percentage of revenue. Margin's getting thinner, yeah? Really low. Okay? You guys getting those numbers? What about other income? So now you come to other income. These other line items get to be a little bit difficult. And you want to think about, well, is it acquire only, acquire plus target? Do we zero it out? How do you think about that? The first question to ask is, where is it coming from? Do both the acquire and target have other income? Maybe only one entity does, and that would affect your decision. So the acquirer does have other income. It's miscellaneous. So the definition of miscellaneous doesn't help us any. The target company also, oddly enough, has miscellaneous other income. It's quite insignificant, but it's still worth consideration. So the question is, in a situation like this, do we add acquire plus target? How do we know how to think about it?
It's core operations, so it's above that.
Yes. So right. So the clue here, we discussed in the template, is most likely if it's above EBITDA, if it's part of EBITDA, above EBITDA meaning it's part of EBITDA, and that indicates to us that it's part of the core operations. And really what we are combining, what you are acquiring in most cases, is items related to core EBITDA. The only time, in my opinion, that you would eliminate an other income if it's above EBITDA is if it's extraordinary, and for some reason GAAP didn't identify it as extraordinary, but we as analysts identified it as extraordinary. However, knowing that EBITDA is not a GAAP line item, it's something that we put together, we must have identified that already, right? Because making the assumption that we built these analyses. That estimation would have been made in building the individual models. So I would defer to, most of the time, if it's above EBITDA, it's core to the operations, add it in, acquire plus target.
In the sense of how would you know if it's core to the operations, would it be a line item saying what it is in your filings? Would it say if it is or not?
You would assume. In this case, there wasn't. It was miscellaneous. Miscellaneous. I had to make an educated guess. Yeah. There was nothing that indicated to me that it was not core. It was occurring every day, every year.
So like a sense of you see maybe like if you saw maybe 1 year they don't have, another year they have.
Yeah, that would be an indicator. That might be one time. If it's one time, they might define it. Changes based on accounting rule changes, something like that. If you see something like that, you'll know that that's a one time. If it's occurring and it's quite steady, it's got to be some sort of, to me, income generating event based on their operations. That's the way I saw it. Again, you had to make that guess, but that was a good question.
Funny though, it's negative though, in a way.
Well, negative meaning it's coming in. Yeah? Is that what it's doing? Yeah, it's negative, it's income. So I'm just going to add Office Depot plus Office Max. And so the EBITDA is simply the gross profit minus OpEx minus income.
Why do we have income as negative?
Yeah.
No, that's just what Brian asked. It's negative
I'm sorry, Brian.
because it offsets, right? Just and what Heather asked yesterday, right? Anything that's not an expense, we're listing as a negative. Yeah. Huh? Yeah.
Or because you were talking about net expense, I mean net interest expense last time, right?
Yeah.
Right, I see what you're saying.
You mean the word income should be in parentheses?
The title's wrong, but they're staying consistent. The numbers.
You're saying it should be miscellaneous expense and then in parentheses income?
It looks like it's
Yeah.
like
I mean, I don't do that.
type of revenue stream.
I don't put interest income in parentheses. I guess. Yeah, if you want to do that, sure. Be more explicit. Expense. Then if it's not core, I would keep the acquirer, eliminate the targets. Yep, good point. If it's not core, I'd bring in the acquirer and not the targets. Okay, so margin, we would calculate. Real thin, right? D&A amortization, like any full-blown model, leave empty until we get that schedule in. If you really want to get a first cut understanding, you could just do acquire plus target D&A now, knowing that you'll overwrite it later. I just don't want to confuse. But you know. And then EBIT is, of course, EBITDA minus each individual depreciation amortization flow. And then you can calculate the margin. Interest expense, interest income. Same idea. Leave it empty until we have it in the debt schedule. I'm still going to calculate, though, net interest expense as the sum of the two. And this will come from the debt schedule. And I'm still going to calculate EBT. I'll still calculate EBT as EBIT minus interest. So the numbers will look the same, but they will change as we populate this further. Save this.
Now, are tax schedules something that we're going to be expected to do, or how common are they?
A tax schedule, you mean with accounting for?
Like in a model.
What do you mean accounting for, like asset, deferred tax assets and liabilities, or?
Right.
I usually do not see tax schedules. And the reason being is, if you have an income loss, what we typically do, and I get it's a shortcut, but this is what I've seen at the banks, you'll have positive taxes. It's going to offset. So in other words, if you have a 5-year projected model, right, and you have a loss here, you're going to have positive 400 in taxes, right? The other way to do it is to build up a tax schedule where you'll reap the benefit of this 400 in taxes in year 3. Either way, your DCF is going to be a wash. So to us, it was unnecessary to build out a tax schedule to that detail. I haven't seen people be tested on it in interviews and things like that. But I mean, that's a shortcut, and building out a tax schedule is good additional detail. So I'm just explaining to you why a lot of times we just didn't get into that. Speaking of taxes, in the effective tax rate, there's a couple of theories about this, and it depends on how the merger is going to come together. Do you calculate a blended tax rate of the acquirer and target? That would be the case if both entities will pretty much exist intact, right? If you are Company A acquiring Company B, and Company B will operate as a wholly owned subsidiary, maybe you'll do that. Or will you keep the acquirer's tax rate? That would happen if the acquirer's entity will exist and stay the same and will absorb the assets of the target entity. Then the target entity is going to be now held under the tax structure of the acquirer. I believe that's what's happening in this case based on the nature of the three transactions that we saw that was building up to this. They're really staying underneath the acquirer's tax structure. So I'm just going to pull in the acquirer's tax rate.
Would that be kind of like similar to what everything did with Tim Hortons in a sense?
Oh, I don't know. I'm not familiar with the deal. What do they do?
Well, they bought Tim Hortons because Canada had a lower tax rate.
Oh, really? Oh, that's interesting.
That was basically kind of the
Okay. Yeah, and you need a tax lawyer and a tax accountant to go through all that, and that gets kind of hairy, but it could be. Yeah, there could be. There's definitely a lot of tax benefits to mergers and acquisitions that can be reaped, and one of the strong positives of it. To conservative, and usually what we'll do is we'll take the acquirer's tax rate for the reason I just explained, because usually you will absorb the assets under the acquiring company's tax structure, but it's important to explain this so that you guys have a good understanding as to where it's coming from. So I'm pulling in the Office Depot tax rate. Copy to the right and multiply. That will give me an adjusted net income. So just make sure you are all matching 976.1. Make sure that works. Ties in the book. I believe it will. Should. Yes. Anybody have numbers to check? Should be pretty straightforward. Which one?
What did you put in the numbers for the income taxes?
The numbers for what?
Anyway.
Got it? Okay, non-occurring events. This could get tricky. Usually they're quite insignificant. There's one here, held the acquirer, recovery of purchase price. Well, the non-occurring events held the acquirer, you will always take. The question is, will you take in the targets or not? And usually not, because they're one time, or they're non-recurring. The only exception is what? There might be other exceptions, but the major exception we just talked about.
Would it be something like, let's say, velocity or something?
No, that would be one time, and that you probably definitely wouldn't take.
Well, that depends. How about if you're a law firm? Let's say for a lot of times you're losing money, but then you gain money if you win in some cases. In a sense, that way you take in because that's core to your operations, right?
Law firms aren't good acquisition targets, or consulting firms, for reasons that you're not really. Consulting businesses, law firms, businesses that don't have tangible assets usually don't merge or roll up in that way. If they do merge, it's like a private, and they're private entities. It's a whole different ballgame. Like private, you're just bringing in the partner and his clients, and it doesn't. The mergers run a little bit differently. But to your point, then that is not non-recurring. That's revenue, and then you'll just do acquire post target. just to I don't want to seem like I'm skirting your question. What are other examples? One that we flushed out last week of a non-occurring event that maybe you would take on. Or non-occurring or extraordinary. Let's say it's recurring. Because in the non-occurring section we put non-occurring and extraordinary items.
So maybe they have a plan over the next 5 to 10 years to close down so many stores or open so many stores in a year.
Yeah, if it's asset related, right, you would probably take that on. So if the target company had plans, maybe had some impairments to assets, then you will probably see those impairments anyway if you are acquiring those assets that may or that will be impaired. So that's something you're not sure, but my point is, if the non-occurring event is related to assets, then you might want to consider taking those on to be conservative. And that actually happened in this case, exactly that point. So looking at the target Office Max, they have non-occurring events. They have two. They have this gain on extinguishment of debt. So first of all, I think debt related, well, in this case, we're taking on the debt, so we might see that. But this is one time. This didn't happen in the future, so you don't care about that. If they have future gains on extinguishment of debts, you got to think about, are you taking on the debt, and are you going to extinguish that debt as well? If you are, then you would take this in. If you're not going to extinguish that debt, you're not going to take it in. You got to think about it that way. Asset impairments, just what I mentioned, are ongoing impairments to assets that they currently own. So unless you're going to divest those assets that are getting impaired, which you're probably not, you're probably going to continue to impair them as it comes due, you'll probably take on that non-occurring event. So my point is, I'm going to bring on all the acquired non-occurring events, and only the target ones related to assets. So think about that. Yes, AJ.
So does goodwill playing for this, or is that only on the balance sheet?
Goodwill only on the balance sheet, but same idea. Okay, and again, you'd have to kind of dig in deeper, and in a real scenario, you wouldn't know. You'd have to wait till the due diligence process to say, well, here are these impairments. What assets are these impairments related to, and are we taking those assets or not? And you'll never know. So as an analyst, you want to just make sure you're not excluding that purposefully. You want to be conservative, include it, highlight it, make sure that's a question for the due diligence process that gets passed on to the auditors and things like that. So in the consolidated financials, what I had done was, just to keep it simple, these other items, recovery of purchase price was one time, loss on extinguishment of debt was one time, so I only brought in the line item that mattered. I only brought in the line item related to asset impairments, and I didn't acquire plus target. But again, it's important to understand why I did that. So the acquire plus target. And a little redundant, but it was redundant like this because I always have the non-occurring events, a section, I had total non-occurring events equal to this one asset impairment in case we later want to add an asset or divestiture or something else that might be one time. So maybe a little bit redundant. I probably should have just taken that out. But so the net income after non-occurring events, 329. Interesting that the net income doubled. Do we have cost reductions?
We went from what?
Oh, the cost savings. Yeah.
500?
Yeah, it's the cost savings. Yeah. Okay. Does everybody have that? Make sure the numbers are matching. How about net income related to non-controlling interests? What do we do with that? Excuse me. Thank you. What do you do with that?
The acquired plus target is you take over the target, but you also take over the non-controlling interest.
How do you think about that? Yeah, mostly. Right? Remember, especially in a stock swap, what you are acquiring is the company's public interests, not its private interests. So you acquire 100% of the company's outstanding shares and options. It does not include the non-controlling interest holder. You have to negotiate him out separately. That's a separate deal. That's a side deal. So you typically bring in the acquire plus target non-controlling interests. Want to consider that. Right, the non-controlling interests, remember, so from the acquirer's perspective, the acquirer's non-controlling interests you'll always bring on. The target non-controlling interests, if they have non-controlling interests, is something that you're not buying out right away. So you want to think about that.
So with that assumption, should you exclude it?
So I would include it, based on what you're saying. You're not paying it down. You're taking it on.
You're taking it on?
Yeah.
The non-controlling interest? So when you buy the target, you get the non-controlling interest, right?
Until you decide to pay him down. So this specifically,
Oh, I think we're thinking about
you're thinking about differently?
yeah, we're thinking about it backwards, as in like the non-controlling interest that owns that company.
Oh, yeah, okay.
I think I was thinking the non-controlling interest that they own it.
That's what it is.
Yeah. Yeah. So if the target company's got a minority interest investor, if there's like a guy that owns 3% of Office Depot, he's not going away. He's not going away. Your purchase price does not reflect him. Your purchase price reflects only the public shareholders. So until we know better, he's coming with you. And you got to negotiate him out separately. So I had to look into the details to find out if he was negotiated separately. And there's a note. It's in page 157. I don't think it's important to read, but there's a minority interest holder, and they actually specifically stated that they can elect to purchase the minority interest owner, but it's a separate deal, and they may or may not do that. So it wasn't in the proxy yet specifically stated that they did buy him out. Until they did buy him out, or they do buy him out, we have to keep it as part of the deal. So we will add in acquire plus target non-controlling interest. So the acquire non-controlling interest stays. It's 0. Doesn't matter. It's minimal. The target stays. Now, what I could have done, and I don't know why I didn't. Well, because he's going to be negotiated out, the nature of it. I could have also projected this as a percentage of net income. Percentage of the net income of the business. But actually, no, that's not the case. I couldn't do that. I couldn't do that. Acquire plus target. I couldn't do that. I take that back.
So looking at this from the other perspective, where let's say Office Max owned non-controlling interest in another company, would that be net in that line, or would that be a separate line item?
If Office Max owned, that's up in other income. That's other income. Yep, and you would take that on and bring that in as income because they get taxed on that. Yep, good clarification. All right, the other side of the fence, this is somebody owns a piece of Office Max. If Office Max owns a piece of somebody else and they get distributions from that, they record those distributions as other income. What about preferred dividends? So this is another thing. Other classes of stock you have to consider. Remember, usually the purchase price only talks about the common stock. So first of all, Office Depot, the acquirer, do they have preferreds? Yes. You're going to take them on. Well, obviously, the acquisition doesn't really have much impact on the acquirer's preferred dividends. Actually, after reading the proxy, I did find out that they were thinking about liquidating some of it. But if they do, it's a separate transaction. Right? So you might have to find some research to reveal that. But the concern is the target. What happens to the target preferred dividends? Does it come on? What do you think about that?
I think it would come on because from then it's just a stock. So the guys who had preferred dividends and whatever, that'd become a different negotiation.
Don't you treat it kind of the same way as that?
It depends. Well, it could be. So we'll look at that in the Heinz LBO. Warren Buffett creates a preferred security to acquire the business. So we'll model that out. And we'll talk about preferred securities. I talk about them here, but we'll save that conversation for a whole class of preferred securities, how to model them, paid-in-kind securities in the LBO. What else? So what does that mean, John? What was your line of thinking there?
Well, I would think you'd use or acquire the targets as well too, since you're acquiring that.
Okay, that's funny. Do I not? Oh, here it is.
Is it not omitted since you're wiping out all equity?
It could be. It depends, right? It's a separate class of shares. So if you're acquiring the public shares, then that's a separate deal, like minority interest, right? You got to look for that. However, so the answer is it's not part of the acquisition of public stock. It's a separate class of shares. But what we do know is on page 163 here, let me just scroll down here, where we looked at yesterday to build out the purchase price, they give you clarification on this. In the beginning, I wasn't sure. In the beginning, I just assumed that they were acquiring the public common shares. And then I discovered this and had to go back and tweak it. It's not so significant, but it's important to get into the detail. And they explain sorry, getting there. There's the balance sheet. It's right after the balance sheet. Here it is. They explain what they're paying for. They're paying for the common stock. They're paying for the stock options. And they're paying for the preferred stock as converted. So they are paying the converted stock, but you cannot assume that as a default. Right? Only if they're convertible. You have to find out if they're convertible and if it's part of the deal. And in this case, it certainly was. And they specifically stated that the minority interest holder was not part of the deal. So you really have to look into the terms of the purchase price to figure that out. And that does take some research. Again, the point of the case study. You really got to dig into the purchase price and look into that. So it's specifically stated here, Series D as converted. They gave a note on it. They said the conversion rate, we didn't care about that because they told us that equated to 2,700 common stock. This is preferred stock convertible into common stock. Only because it was convertible and only because they converted is this part of the purchase price. Otherwise, it would have to be a separate transaction. Because it's part of the purchase price, it's eliminated from the target financials. So things to look for. So we're just going to pull in the acquirers, preferred dividends. It was insignificant anyway if you had missed it. Consolidated financials, pull in from Office Depot only, already projected. And we have net income after distributions.
I'm sorry, Paul, what was the key word that made you know we weren't pulling in the targets for preferred?
The line item here that said that they converted the preferred stock into common stock. Number one, that it existed as part of the shares that are going to acquire in this table. And number two, because if this wasn't so explicit, well, we want to look to see if the preferreds are convertible into common stock at a certain price. And they were convertible above 45, was it 45? Whatever it was. That doesn't make sense. But they were convertible at some term.
I mean, do you have to convert? Can you just buy them out? Or is it just a conversion, it's just their price?
You could buy them out, but you wouldn't have to if they don't convert. They lost their chance. Burn them. Right? If they don't convert and the contract says change of control, I mean, maybe you can try to get a lawyer and fight to get some liquidation out of it, and then this is where it gets kind of great.
But Paul, if they do convert, then we don't animate, but they're including the diluted share count of the target.
So the acquirer.
The acquirer?
Yeah, because right, just the target diluted share to be acquired by the acquirer.
Exactly. So
Yes,
that's how we calculate it. It's
Yes.
to get that.
Yes.
The math anyway.
Yes, that's right. That's right. And lucky for us, they did that for us, but that's how you would account for it. Yep. Good clarification. So, net income after distributions, which would allow us to calculate accretion dilution. And you do it first by pulling in the acquirer EPS. We're going to pull in the acquirer EPS, Office Depot EPS, which is this adjusted EPS. Now, just a side note, I don't know if you care or not, but this is something I had to do. This was the reported EPS, negative, not available. So I struggled. You can't have accretion dilution if the EPS was negative. So I had to create my own EPS. I realized that it was positive if you pull out the asset impairments. So I had to do an EPS off of the pre-non-occurring net income in order to get a positive EPS. You might find a struggle with that. And so the rule is if you're going to do accretion dilution, your pro forma EPS needs to be the same type of EPS as the acquirer standalone EPS. So in other words, the EPS is reported as negative because they had these non-occurring events in there. So I have to create my own adjusted EPS that was pre-non-occurring events to get a positive number. So I'm going to use that EPS, the adjusted EPS. So I'm going to pull in the adjusted EPS basic and diluted. Just copy to the right, copy down. And I'm going to calculate accretion dilution, but I need to calculate pro forma EPS. And you've got to make sure that the EPS that you're calculating, the pro forma EPS, needs to be the same type of EPS, because EPS can be based on adjusted net income after distributions, after non-occurring events. So my point is, even if I got everything under the distributions wrong, it's not going to impact my EPS anyway, because I'm working off of adjusted EPS. And honestly, in a merger and comps, you usually work off of adjusted EPS anyway. You want to look at the EPS without non-occurring items anyway. So my EPS is going to be based on the net income adjusted divided by shares. Now, I got to calculate shares. I forgot about that. Before we can calculate EPS, we have to calculate shares. So we need to pull in the acquirer shares, Office Depot shares, basic and diluted. Just pull it in from the acquirer model. And we then have to calculate new shares. How do we calculate new shares?
Treasury.
No, don't need to do that.
Oh, wait, no.
No, I mean, that's to dilute the shares. They're already diluted.
We have in the assumption of 2.69.
So it's the total purchase price.
Of what?
Divided by the share.
Yeah, I mean, the standard rule is, just like in the M&A model, it's always the amount of equity raised divided by the acquired stock price. We're raising $940.6 million at our acquired stock price. That's the way to get the shares. But because we have calculated the stock swap in a different way, it's actually going to come out to be 249.5. So you could have pulled in the 249.5. But to be consistent and to make it easier, the way we always calculate the number of the number of issued shares is going to be equal to, on the assumptions tab, the equity raised divided by the acquired stock price. That's the easiest way to always get us to back into the number of shares raised. We want to raise, we're the acquirer, we want to raise $940.9 million to buy the company. How are we going to do that? We're going to raise it at our stock price, of course. That gets us to 249.49 million shares. So I'm going to anchor this so I can copy to the right. Which means we add that to the basic and diluted shares respectively to get the new basic and new diluted shares. This is just how we did it in the mini merger model. So basic shares plus new issued shares, new basic shares. Diluted shares plus new issued shares, new diluted shares. Copy to the right. Now we can calculate our new EPS. So make sure you're getting those numbers. Let me know if you have questions. Okay. The new EPS is the net income before non-occurring events, to keep in line with the type of EPS that we're pulling in from the acquirer, divided by basic shares, new basic shares. 90 cents.
Do we have to do this without asset impairments, though, to match up?
Yeah, before non-occurring events. Yeah, that's the asset impairment. And then the diluted is the net income adjusted, right, meaning before non-occurring events, divided by the diluted shares. And we copy to the right. and we calculate accretion dilution. Let you guys catch up. Accretion dilution is just the difference. New divided by old minus 1. And you can copy that to the right and down. Now, it's very high. It's going to be high, we expect, because of the 10% reduction in synergies, but it's also going to be high because we don't have D&A and interest expense in there yet. Once we get that in there, we'll see how it changes. But let's take a second, make sure you get that. That's the process. So it's not too different, but there is some subjective things that you need to analyze. Why revenue is growing the way it is. Why other income is coming in. Look at the distributions. You have to analyze deeper. Hopefully you're seeing things that you're going to see in this case that we didn't catch in the template. Why some distributions are coming through, and it depends on all the nature of the acquisition. Why some non-occurring events might be combining. That's the point of the case study.